So today we're going to look at partnerships, and we're going to look at performing certain things as relates to partnerships. We have starting a partnership and the entries that are associated with that, and then recording share of earnings for partners. And so let's start with recording the start of a partnership. In the example here, we have according to their partnership agreement, which of course is the thing that lets us know how we should figure it out or how we should divide up things. It says that Mind, like who is a partner, will invest 28,000 in cash and 37,000 worth of furniture and displays. And Padilla will invest 40,000 in cash and $30,000 worth of equipment. Related to the equipment is a note payable for 10,000, which the partnership assumes. So what we're going to do is we're going to take this information and I'm going to do one entry, assuming that this note does not exist. And then I'm going to do one, assuming that it does. So for the purpose of a lot of things, I'm going to just put this in here. And I'm just going to put this on the screen here. And merge and center it for a minute. Okay. So this is the information. And so what we're going to do, this requires us to prepare a journal entry. And so as we're looking at a journal entry, we should know that a journal entry should have a date. Normally it has a date. It has an account name, a description in most cases, but we're going to put the description underneath according to your textbook. And then we're going to do a debit and we're going to do a credit. Okay. And so right now we're going to assume that it's going to be today's date, which is January 13th, 2025. I'm going to use that as today's date. So we're assuming that they're starting this partnership as of today. And so, of course, with any journal entry, like we know with the double entry system, we need at least two accounts that are going to be, one should be debited, one should be credited. Why? Because it should always be in balance. What happens on the left side, which is debit, should happen on the right side. And so it's up to us to determine the accounts that we use. Whenever we think of a partnership starting similar to a sole proprietorship, somebody brings in something, normally it's assets, and those assets are recorded, and then the other side goes to capital. That still stands. The difference is that we have multiple partners, so we have multiple capital accounts. And so in this case, we can do an entry for each partner just to keep it simple, or we can actually combine it. And so I'm going to do each partner first and then show you how we can combine it. And so it says the partnership agreement. So Mind, we know is the first partner. They invested 28,000 in cash and $37,000 worth in furniture and displays. The accounts we're going to use is going to be based on what happened in the transaction. They invested cash. Cash is an asset. So that means we have to say that the company or the partnership company now has $28,000 worth of cash. So cash is increasing, meaning that I need to debit it because it's an asset. So I'm debiting cash for $28,000. On the other hand, they say there's $37,000 worth of furniture and displays. Furniture and displays, that is going to be the name of the account. Normally, the sentence tells us. And so we're going to use furniture. Furniture and displays as our next asset account, and it's worth $37,000. And so that's everything that Mind brought in. So that therefore means that Mind brought in a total of $65,000 worth of assets into the partnership. Based on the agreement and based on our understanding of partnerships, these things are now the partner's assets, no longer Mind's assets. They're now the partnership's assets. And so that means that this is the value of his investment in the company. So therefore, we should have a Mind capital account. And that, of course, should be indented because we know that capital accounts, when you make an investment in the company, that means you're increasing your capital, and increase the capital is with a debit. And so therefore, we also know that journal entries have to balance, meaning that the total on one side has to be the same on the other side. Well, I'm not going to do it like that. If I add the two, like I said, it's 65,000. So then that means mine actually would have brought in $65,000 worth of capital. And so for mine, this is the entry for mine's transactions. Then it says Padilla will invest 40,000 in cash and 30,000 worth of equipment. And so technically we can follow, I'll copy and paste it down. We can follow the same thing, except that cash was invested, cash was $40,000. So that doesn't change. Why? Because he brought in cash just like mine. So his amount was just different, but the fact remains the same. He brought in cash. So now the partnership has $40,000 more cash. He brought in equipment worth 30,000. So it's not furniture and displays. It's gonna be equipment, and it's gonna be 30,000. Like I said, for now, I'm going to ignore this last sentence and do that after. We're going to treat it as two different transactions. Here we have the equipment for 30,000. And so that means that Padilla is now the next partner. So I'm going to take out mine. I'm going to put Padilla Capital. And with Padilla Capital, the total that Padilla brought in, excluding this note payable, we're going to act like that doesn't happen right now, $70,000. So that means his investment, or his or her investment, is $70,000. And so if I was to do two separate entries for both partners, this would be the two different entries that I do. This would be correct. Now, me showing you a combination doesn't mean that this is not correct. It's just that you have the choice to do it separately, or you can combine it. And so in combining it, what normally can happen is we look at the accounts that are present, and where we have accounts two accounts with the same name, cash and cash, I can actually just add those two together, the two numbers together. And instead of debiting cash one time for 28 and one time for 40, I'll debit cash for the total of all my cash transactions, which is 68. So if I was to combine this, it would just be 68,000 go into cash instead. Furnitures and display would still be 37,000. Equipment would still be 30,000. Mine, Padilla, would still be 65. And Padilla Capital, well, mine capital would be 65, Padilla Capital would be 70. So the only time the number would change is if I have two of the same accounts being debited, I would just add them. If I had two of the same accounts being credited, then I would add them as well. If I go back and check, my total debit should still equal my total credits. If I've done it right, my total debits is 135,000. My total credits is 135,000. So it's these essentially are the same thing. You don't need both of them, but I'm just showing it to you just as an advanced understanding of accounting. This is one way to do your entry. This is another way. It still follows the concept of double entry, whereas you have to have at least one debit and at least one credit. In this case, we have multiple debits and multiple credits, but what stands the same is that when you add up your debit column, you add up your credit column after you've done your entry, it should balance. If it doesn't, it's going to be incorrect. Okay? And so I just wanted to show that. So I'll hide this because it's not relevant. Like I said, it's either or. I'm going to stick with this one for now. And so this would be the entry if I ignored. So if I ignored the note payable. Now, let's say I'm not going to ignore the note payable anymore. I'm going to do it completely, right? So this is, yeah, let's just keep it at that. That is what it is. And so now let's make an adjustment to the entry now, because what I'm not going to do is I'm not going to ignore the note payable anymore. I'm going to record it just as it says. And so based on what it says related to the equipment is a note payable for $10,000, which the partnership assumes. So that means the partnership, yes, they know they took on the value of the equipment, but what they also did is acknowledge that, okay, there's a note payable that goes along with it. Based on the partner who brought it in, that should affect their capital only. It shouldn't affect the other partner's capital. Okay. And so that means then the equipment was brought in by Padilla. So that means technically we have to add this note payable within the entry for Padilla. Now, note payable, we understand payable, the word payable suggests that it is a liability account. And what we're doing is we're acknowledging that the partnership now has a new liability. So we have to add that liability to the books. And so we can put it simply as note payable. And we know once we're adding a liability, we should be crediting that liability account. So I'm going to indent that, and I'm going to put 10,000 under the liability section. If I take a look at my debits and credits for Padilla, it's not going to be in balance anymore because I have 70,000 on my debit side. And with the addition of the 10, I now have 80. So what that means then is that Padilla's capital actually has to decrease by 10,000 so that I have 70 and 70. So whenever a partner brings in a note or a payable balance that needs to be paid by the entire partnership, the value of their capital investment goes down as a result. So assets are added, liabilities are subtracted. They're never going to bring in expenses or revenue or anything like that because that starts as soon as the company starts to generate expenses and revenue. But when we bring in partners, partners are only going to bring in assets or liabilities.